Hi friends, welcome to A to Z Learning channel. Today's video is part of our education on some of the investment products. Today, in this video, we are going to be picking up exchange traded fund ETF. What are these funds? Why do you need to invest in this? How do you invest in these funds? And how do you select these funds? There are so many questions that come to your mind when you think about a new financial product. ETF, though has been present for some time, it's still very new to many retail investors. It has got many advantages. It has got excellent product design, which for the right portfolio objective, it could be a great product for you as a retail investor to have in your portfolio. So without further ado, let's start our video where we'll go through all aspects of ETF investment in a very simple manner so that you can understand and follow. And if you like it, then you can make the decision of including this also as one of your investment product in your portfolio. So let's kind of start our video. First question when you kind of think about a new financial product is what is that and how do you invest are the kind of two high level questions that come to mind. But today we will explain you ETF as the financial product and will help you answer four key questions. What is it? Why do you invest in it? Or why should you invest in it? How do you invest in it? And how do you select it? So all the basic questions that you need to know around ETF will be covered in this video. So let's start with the first question. What is ETF? ETF, first of all, please note, ETF stands for Exchange Traded Fund. Yeah, Exchange Traded Fund. ETF is nothing but a simple basket of securities that trade on an exchange, just like a stock. So if you think about, you must have heard about Nifty 50, you must have heard about Nifty 200, Nifty 500. All these are index traded stocks. So Nifty 50 is nothing but the top 50 companies in India. So if you as an investor are looking to invest your money and you want to invest in the top companies of India, one way is that you pick up these 50 companies individually, say Hindustan Unilever, ITC, HDFC Bank, you kind of name it. All these companies you pick up individually and invest in it. Or ETF it. What ETF does is basically your Nifty 50 could be one ETF. Whereas you may be investing only 1 lakh rupees or 10,000 rupees. You just straight away go into ETF and that way your 10,000 rupees is invested in all those 50 companies. If you pick up individual stock, even if you invest say 1,000 rupees in each stock, you'll still end up spending 50,000 rupees. But ETF allows you to invest whatever sum you are looking to invest, but that gives you exposure or benefit or return from all those 50 stocks. Similarly, Nifty Bank. Nifty Bank has got 12 banking stocks. You can pick up 12 stocks individually, 12 of those banks individually, or you could simply say that I have got 20,000 rupees, 50,000 rupees, whatever the amount is, and then you just kind of invest in Nifty Bank ETF. That gives you the exposure of all those 12 banking stock, which are part of that Nifty Bank ETF. So it's nothing but a basket of securities, basket of shares, and it is traded exactly like a stock. It goes up and down based on the as the ETFs are bought and sold. So it's a real-time price. It's different from mutual fund. You may have heard about index fund, you may have heard about mutual fund. It is different from those. ETF is like a direct stock. Like direct stock goes up and down during the day and you can buy in or sell anytime during the day. Whereas mutual funds or index funds, the key difference is you can invest only at the rate which will be known when the market is closed, when the NAV, when the market price is known at the end of the day. So if you give, say, a mutual fund company 50,000 rupees, they'll take your 50,000 rupees on that day, but then they'll wait for that day end when the markets close. They'll determine what is the price of their mutual fund unit, and then they'll apply that price to invest your 50,000 rupees. Whereas ETF is when you invest 50,000, your investment straight away has happened. So that's the main difference. ETFs, can this be only for stocks? No, it can be for anything. They could be gold ETF, they could be commodities in ETFs, they could be debt events ETFs, or bonds ETFs. So it covers all type of investment. So depending on which investment underlying investment you want to make, you can choose the ETF that suits your investment goal. ETF generally offers very, very low expense ratio, and they are free from those broker commissions that you kind of see. Not free, I would say fewer broker commission than you would typically see in a stock trade. India ETFs have outperformed quite significantly compared to the broader market in the recent past. So overall, hopefully you will get the feel that what is ETF, how kind of you basically can trade in these things, and also a little bit of history in terms of low expense ratios and fewer broker commission, and they as a asset class have outperformed the broader market in the recent past. Now let's move to the second question. Why should one invest in ETF? In my mind, there are two main reasons. One is it first of all combines that it gives you a exposure to a diversified portfolio with the simplicity of as if like you're buying only one stock. So like I was saying earlier, Nifty 50 is one of the ETF. You could buy Nifty 50 and that way can have the exposure to all the underlying 50 stocks that are there in that ETF. So it has the simplicity as if you are buying only one stock, but it giving you your portfolio, diversifying your portfolio to cover all the 50 companies in that stock, in that exchange. So that's the first reason one should do it, because if you have little time or little knowledge, or you want to mitigate the risk of picking up a company which may not perform that well in the future, all those risks can be managed better if you simply go for ETF. It allows you, the other reason, I think it allows you a broader exposure. So sometime you would see that in the Nifty index, overall index has gone up, but individual stocks like banks are down, uh, or IT is down, or pharma is down. But overall, the exchange has gone up. You would see many times. So if you invest in the Nifty 50 ETF, you will get the benefit of overall index going up. But if you go for individual stock, that individual sector or stock may not perform as well when you invest. So that's the other advantage, that you don't have the risk of individual stock because your money is broadly invested. Otherwise, could be, as I said, that it's a low expense way, it's a passive way of investing. You don't need to kind of do huge amount of research. You can just trust in the exchange because you're getting exposure to all the top companies. Or if you go for say Nifty Bank, you're getting exposure to all the banks. So if one bank doesn't do but 10 other banks do well, you'll still benefit. You don't need to kind of spend time and research that which one to pick up. So you can pick up the whole lot. Now let's move to the third question, which is how do you invest in an ETF? It's a very straightforward process to invest in ETF. All you need is basically a simple demat account like you need for buying any individual stock. You need a demat account, then You buy the stock like you buy individual stock. You need to just pick up whether you buy Nifty 50, you want to buy Nifty Bank or whatever. And you can see all this list on the NSE website, or Money Control. There are lots of kind of places where you can Google and find out which particular ETF you want to kind of purchase. And then you just pick up that in your demat account and buy or sell as you normally kind of buy or sell your individual stock. It is traded like real time, like an individual stock. So you place the deal, you give a price, you buy that, and then it's in your demat account. And a day later, if the index goes up and you're kind of seeing that your value has gone up, you can sell it like you sell or buy individual stock. So it's a very straightforward way of buying or investing in ETF. Now the question, the last and the most important question comes is that how do you select an ETF? Because that's always tricky. It's like we know that it's very hard to pick up the stock, individual stock. It is also equally hard to pick up which ETF to invest in. So today I'll be sharing with you a guide of three selection criteria that you can consider when you are looking to invest, when you're looking to select an ETF for investment. What are those three selection criteria? They are on your screen now. So first of all is look for liquidity level. So if you're going for an ETF stock, make sure that you're picking up the one which has got the high level of liquidity. Why does it matter? Like in the individual stock, you have got individual stock like Reliance or HDFC or HUL, which are heavily traded in a day on the exchange. So if you want to sell or buy, there is always someone else available in the market who will be able to transact with you. But then there are some kind of very, very small and medium sized stocks in the market where sometimes you kind of place a trade, and for many kind of minutes or hours, there's not the trade is not happening because that stock has got very few buyers and sellers in the market, or trading volumes are very, very low. So always look for, when you look for ETF investment, always look for one which has got high level of trade and therefore high level of liquidity available. The second selection criteria is pay attention to the expense ratio. The fund houses that run the ETF for you, they charge for their expenses because they are paying for the trading costs, they are paying for the staff who's helping them manage these funds and so on. So they charge certain expenses on the fund. So make sure that you are going for the ETF which has got the lowest level of expense ratio. And as a thumb rule, you must not pay an expense ratio which is more than 0.1% or 10 basis points. Anything higher than that means you are being charged too much, or fund house is not efficient in terms of managing its ETF. So always look for something which is less than 10 basis points or 0.1 percentage. Okay. And then the last and the most important criteria to be picking up while selecting an ETF is the tracking error. Tracking error is basically that what will be the typical difference between actual index performance and the performance of ETF that is tracking that exchange. So let's take example. Say Nifty 50, which is our index, say it was 10,000 today and it becomes 11,000 a month later. So 10,000 becoming 11,000 means a 10% return. But some of these ETFs may be giving you not full 10%, but maybe they will be giving you say 9.9% or 9.8%, that sort of return. The difference is usually because the money comes in and goes out from the investor, so it becomes difficult for them to kind of, by the time they kind of replicate and invest in the individual stock, uh, there is usually time gap, so that's gonna, and plus the expense ratio that they charge is also coming from the return that they are offering. So usually the difference between the actual index return and what ETF fund is offering you, there is a difference. So, and that is called tracking error. So that tracking error is basically nothing but the difference between the actual index's return versus the return of ETF that you have bought. What is the typical? So clearly, you must go for an ETF which offers you the lowest tracking error. But as a thumb rule again, you must not have an ETF which has got a tracking error of more than 0.3%, which is 30 basis points. Anything higher than that means again fund is either very, very large, therefore they're finding it difficult to keep their costs down, or the fund is inefficiently managed or ETF is inefficiently managed. So always look for a tracking error which is below 0.3% or 30 basis point. And there are lots of options that you will get in the market which offer. So if you go to a website called Ticker Tape, and look for say Nifty 50 and go for the ETF section under that, you'll find all the kind of fund houses that are selling their ETFs, and you will get the criteria information on liquidity, expense ratio, and tracking error there itself. So you can easily get this information and pick up the fund that suits your investment goal. So I hope you found this simple description on ETF helpful. Please do let us know via comments how did you find this video. If you really like this video, then please press the like button and share. Or let us know if you think something was missing in this description, then we would love to hear from you what is missing in this. And if you really like, let us know through the comments and what bit you really like most in this video. And last but not least, if you've not subscribed our channel A to Z Learning as yet, I would urge you to please subscribe and become part of our viewers family. Thank you very much for watching our video. Good luck with your investment decision.